Hey everyone, and welcome. Today, we're going to roll up our sleeves and solve a really common but kind of tricky puzzle in the business world. What actually happens, financially speaking, when one company buys another? It sounds simple, right? But getting to one true financial picture is a fascinating process. So let's dive right in.
So, let's kick things off with the big question. Imagine a big company gobbles up a smaller one. Now, they might keep their own logos, their own buildings, maybe even their own company picnics. But for the people who really need to know what's going on, the investors, the banks, are they still looking at two separate businesses? Or is it now just one big operation?
Here's the game plan for how we're going to piece this all together. First, we'll talk about why this is even a puzzle to begin with. Then, we'll define our main characters. After that, we'll walk through the first basic step. Then we'll get to the juicy part. What happens when the price and the value don't match up? That'll lead us on a hunt for something called goodwill. And finally, we'll put all the pieces together to see the finished picture.
Okay, first things first, the puzzle itself. So even if the two companies stay as separate legal entities, U.S. accounting rules have this thing called the economic entity assumption. And all that really means is if one company controls another, we have to look at them as a single economic team.
And that's our goal right here. The whole point of this exercise is to create one single, consolidated financial statement. It's about cutting through all the legal jargon to give investors and lenders the real story, showing them all the resources and all the debts of the combined company under one roof.
Now, you can't solve a puzzle without knowing what the pieces are, right? So we got to define the key players in this whole merger game. Let's figure out who's in charge here. And honestly, it's pretty straightforward. You've got the parent company, we'll just call it Company P. That's the buyer, the one in the driver's seat. And then you've got the subsidiary company, we'll call it Company S. That's the one that gets bought, the one being controlled. Simple as that.
But, and this is super important, it's not always just about owning more than half the stock. The real magic word here is control. Control is the power to call the shots, to direct the subsidiary's business in a way that affects the parent company's bottom line. That's the thing that really triggers the need to create these combined statements.
All right, now we're ready to actually start building this thing. Let's get our hands dirty with the very first, most fundamental step in putting these puzzle pieces together. This is called the basic elimination.
Okay, so we start with two completely separate documents. On the left, you've got the balance sheet for our parent, Company P. On the right, the balance sheet for our subsidiary, Company S. Now, don't squint and try to read every single number here. That's not the point. The big idea is just to see that we're starting with two separate sets of books. Our job is to make them one.
To make this happen, accountants use a special tool called a consolidation work paper. You can just think of it as our game board for this puzzle. Now, the first move seems really easy. You just line up the accounts, cash with cash, land with land, liabilities with liabilities, and just add them straight across. But that actually creates a big problem.
And here's the problem. If we just add everything up, we end up counting the same thing twice. See, the parent company has an asset on its books called investment in Company S. Meanwhile, Company S has its own pile of stockholders' equity. But here's the thing. Those two accounts are just two different ways of looking at the very same pile of assets. So if we keep both, we're double counting.
So how do we fix it? With a clever little move called an elimination entry. This is the magic step, where we take the parent's investment account and cancel it out against the subsidiary's equity accounts. Poof! They just zero each other out. The double counting disappears, and our puzzle starts to look right.
Okay, but that first step, that's the easy mode. In the real world, things are almost never that simple. And now, now the plot thickens.
This gets us to the real head-scratcher. What happens when the parent pays more for the subsidiary than it's actually worth on paper? Let's say Company P pays $100,000 for Company S, but Company S's book value, its assets minus its liabilities, is only $80,000. Where did that extra $20,000 go?
To solve this new mystery, we need another tool. It's got a fancy name, a computation and allocation of difference schedule, or CAD for short. You can think of this as our detective's worksheet to track down that extra cash and figure out exactly what it was spent on.
And this little investigation leads us on a hunt. We're looking for the final, and often one of the most valuable, pieces of our puzzle. It's a special, sort of invisible asset that only ever shows up when one company buys another. In this flowchart here, this is our treasure map. Let's follow it together.
First, we compare the price we paid to the subsidiary's book value. That gives us the total difference we need to account for. Next, we go through the subsidiary's assets one by one, like their land or buildings, and see if any of them are worth more in the real world than on paper. We assign some of that difference to them. And then, whatever's left over, that little bit that we can't explain with physical stuff, that's our treasure. That is goodwill.
So what on earth is goodwill? Well, it's called an intangible asset. It's the official accounting name for all the valuable stuff a company has that you can't really touch or put in a warehouse. We're talking about things like a killer brand reputation, a super loyal customer base, brilliant secret sauce in their operations, or even just the amazing potential that comes from putting the two companies together.
So why would any company do this? Why pay extra? Well, a company's book value is usually just the tip of the iceberg. There's all this hidden value under the surface. Maybe the subsidiary owns land they bought 50 years ago that's now prime real estate. Maybe they've poured millions into research that isn't on the books as an asset. Or maybe the parent is just making a bet on the future, paying a premium for control and all the amazing profits they expect to make down the road. Okay, so after all of these steps, the adding, the eliminating, the allocating of that extra cash to assets and to goodwill, we are finally ready to see the final completed picture.
And there it is, the puzzle solved. This is the final consolidated balance sheet. All the individual pieces are now blended together. The parent's investment account? Gone. The subsidiary's equity? Gone. And in their place, we have the combined assets, the combined liabilities, a single set of equity, and look, our newly discovered asset, goodwill. It's one complete and perfectly balanced financial story.
And this, right here, is why all this work matters so much. This single document gives anybody who's interested, investors, lenders, you name it, the clearest, most honest view of the new, bigger company's total financial health. It's not just an accounting game, it's about providing financial truth.
So as we wrap up, I'll just leave you with this one last thought. We've successfully put these two companies together on paper and solved the accounting puzzle. But the much, much bigger challenge, the one that starts the day after the accountants go home, is figuring out how to make them actually act as one. And that is a puzzle for another day. Thanks for joining me.